I was not accepted the first time I tried, and I think that was a very good decision for the people who made that decision.
This is the Person of Interest podcast, where we meet extraordinary people with a story to tell.
Well, welcome back to the Stockholm School of Economics here in Riga. I may sound a little bit muffled for this podcast for obvious reasons, and you may also catch a little bit of background noise. We have windows open, and as we're observing the full range of social distancing and precautionary measures, everyone around me is also wearing masks, apart from my guest today, who has the privilege of being the one without, Andris Kotans. Andris, welcome.
Well, thank you for the invitation.
Andris is a board member at CBL Asset Management, which is part of Citadele Group, Latvian financial group. Before we get into our main topic, which is going to be funds, an area in which you specialise, it's traditional for me to delve a little bit into your background and particularly your connections with SSE Riga, and I think you probably have more extensive connections than a lot of people. So, what's your history with SSE?
The full history probably starts with the fact that I'm the graduate of the school. I graduated in 2002, so it's almost 20 years soon that will be turning. I think as it has been for many of the graduates and alumni, and it's probably not only at SSE, but on any university. University years are probably the years where the personality largely shapes up, where the interests and future plans gain some format. Everything before that was more or less something that was a bit childish, I think, in most of the cases at least. And I think that has been also the case with me. I wouldn't say that I had a grand plan for my life when I was graduating, but I think some of the interests that have eventually shaped my further career have shaped here. Several very good relationships originated in this institution. So I think it is very fair to say that this institution has had a very significant impact on my life so far, and probably will have also going forward. But yes, speaking more academically, I think this was the place where I had studied economics before that in some high school level and so on. But I think it was really a bit of an eye-opener on subjects like macroeconomics or finance, the almost legendary courses by Morten Hansen or Peter Hochfeld. Those, I think, are the courses you might have enjoyed or hated or whatever, but those have been very significant parts of this experience, and that has been also the case with me. So after graduating, I worked a bit in audit and consulting with Ernst Young, but I realized that I wanted to do a bit more academic. I realized that it's kind of now or never to really examine what the academic economics is about, and that's how I ended up doing my master's at Central European University in Budapest. Had really a luxury of spending 2 years of working on really education of myself in various fields, but of course focused on economics. And although in part was that I realized that I'm probably not going to be a full my career will not be in academic economics. It's rather the application that I like, and rather the interpretation of models that I enjoy most, rather than developing mathematical models for economics. But that has been a very good. That was a very worthwhile experience. And then when in parallel, as I was thinking where that really leads me, I slowly came down to asset management or financial markets as an area where a lot of those things interconnect. I mean, it's of course the financial markets is about economics and finance. That's plain and simple. But when you're really involved in them daily, you realize how much of many other things actually you are exposed to intellectually. You are faced with I don't know, international relations or history or even sometimes I think culture or personal psychology and how people behave. You realize that it is a living organism after all, and you need to be not only smart in finance and economics to realize of what's really happening, which you I think really cannot ever do as our I don't know individual intellectual capacity is limited to fully understand on each given moment what is happening on financial markets, but it certainly challenges in you in many ways. So that has been what has kept my interest so far in asset management industry, and that's how my career has developed so far. Maybe how it's a bit long intro, but coming back to my relationship with the school, it is also that I've never really departed very far away. Over years there were maybe periods where I was more preoccupied with other things, like I had small children and everything, but I had some relationship with the school always. I did some term paper supervision or bachelor thesis and EMBA thesis supervisions, and a few years back I also got actively engaged in the Alumni Association, and as we speak today I'm the acting president of the Alumni Association, so that is kind of at the moment how the circle closes, right? That's largely for the intro, I think.
Well, that's ideal. I mean, that's saved me from asking a lot of annoying little questions because you've given a great overview. But I'm really interested in this idea of the interconnectivity of the financial markets and funds and so on, which we'll return to in a moment. But I thought it was interesting while you were talking that you mentioned that you had studied a little bit of economics at high school before you came to SSE, and then before you've gone on to Central European University, which is another fascinating institution probably, and that was probably a fascinating time to be there. But what was it that kind of turned you on to economics even at high school as a kind of primary interest? Because, it's, to be honest, it's not the kind of rock and roll subject a lot of the time, is it? So what was it was it just a sort of affinity of your character? Was it being good at maths? Was there an inspirational teacher, or what was it?
I think if I'm honest, and I think in my age you start to be very honest about things. I think I was one of those many bright students who actually don't have a good plan of what they really want to do with their lives. They're good at many things, and then they have a bit hard time choosing. And I think that was largely my case. I'm a pretty typical graduate of Riga First Gymnasium, so pretty good at math. Even once got some good places in mathematics Olympiads, etc. So mathematically minded and structured thinking. That is about me. At that point, SSC was really very special in the sense that you could get an international quality education for free. You basically didn't even have to pay for it. Anything. So it was a no-brainer deal in economic terms, right? So I did apply, and I think one of the early life learning and life shaping experiences was that even I thought, I think exactly because I was thinking that I'm pretty smart and there's no chance of how I could not be accepted. I was not accepted the first time I tried, and I think that was a very good decision for the people who made that decision, because I think it would have been a mistake, and I probably would have a more painful hit somewhere down the road if my kind of success just continued.
So it kind of gave you a reality check.
Yeah, I think it gave me a very worthwhile reality check. So I'm not sure who has been that person who made that decision, but I'm actually thankful to that person at this stage. But yes, other than that, I think well, the year actually I spent in between, I did actually two universities at one go, plus doing actually some work. But I did study mathematics at the University of Latvia, and then in parallel there was a new program launched at the Citadele University in economics. And the interesting thing about it was that the way I could combine those two things was that I was actually reading a lot about in all of those courses, and the economics program in particular. So as I could maybe miss some classes, I was making it up with extensive reading, and I think that was really maybe the point in time that I realized that I am interested in this subject of economics, broadly speaking, because it.
I mean, were there any particular works or that really resonated with you?
Not sure. I cannot maybe. I actually think there have been, but I would have to do a bit of digging up to identify one. But it certainly confirmed my interest in the subject, and I think what we come down later on is the multidimensionality of things, and I love multidimensionality about economics, broadly speaking, because there's certainly the numeric accuracy involved, but then there are also humans and human behavior involved, which then is the big puzzle. You on one hand, economics makes the assumption of rational individuals acting in a certain system, but I think there's no really debate about it that our rationality is bounded. We're only partly rational as individuals, and that's why basically none of the classical economic models will work exactly as it's supposed to. It will always work out somehow differently in real life. But I think that is really what makes it interesting.
And there's a slightly indelicate question, but one which has to be asked as well, particularly when you're talking about being involved in the kind of the financial markets, the investment side of things. Was the opportunity to make a lot of money a motivation as well? Because we've been talking a lot about the academic attraction, but exactly. I mean, that is often a big motivation for people too, right?
I think, again, at this age, you start to be honest about things. I think for me, if I analyze myself, I'm not outrageously motivated by money, but I certainly also don't disregard it. I think an individual needs to I think actually there's this movie Forrest Gump, and there's this episode where he receives this letter that he's now a shareholder of Apple, and that basically he no longer will have to worry about money anymore. I think that is a very good state an individual can achieve, that you don't need to outrageously worry about your money.
They used to call being comfortable.
Yeah. It basically frees up a lot of attention that you can devote to other things. So I think that is really the ideal status one can strive for. I'm not sure I'm there yet, or where that really is, but I certainly have some attention span that I can devote to other things than just worrying about what will I give my children to eat this evening or the next. And unfortunately, that is also reality somewhere.
And also because when you're operating in a fund or something, I mean, everything's benchmarked against other people doing the same job. It's kind of highly competitive, yes. But maybe in a directly comparative way that maybe doesn't apply to some other jobs, where you might think you're better at doing X or Y than someone else. But if it turns out that they've turned in much better results than you, then everyone in the industry believes that they're better. Or is that a sort of oversimplification of the competitive masters of the universe type take on fund management?
I think it is very competitive. Then again, the way you measure performance and the way you objectively judge an investment manager's performance is again a multi-dimensional problem. And then we can go back to how good an idea is to have a very predefined benchmark for a portfolio of whatever type. There are situations where it's very appropriate and where I think it might be less appropriate. But generally speaking, the coming back to your question on the making money, I think making money should be a part of it's a challenge in itself that makes it interesting. So I don't shy away from being, I don't know, partly driven by that purpose, but it's certainly not the only purpose of I think anyone being in the funds business nowadays. Even more so, I would say that at least the European regulation for the funds business is actually limiting how this works. There's the times of excessive bonuses to asset managers or to banking managers or anything in the financial world are by and large gone. So it's no longer the Golden Valley where you think you will make a quick million and do whatever else. That's I would largely say that it is a maturing industry without any major excesses. I think.
Well, that takes us nicely to the point that I wanted to get to, which is to the layman such as myself, or even someone who might mention or read about funds in the newspaper and think we know what we're reading about. I've got a feeling that really I don't really know very much about it at all. So can you explain the basics of what a fund is, how it operates, and why it's important? I appreciate that this is a great multiplicity of funds, but the essential mechanics of it.
Well, the essential mechanics is very simple. You accumulate funds, resources of individuals into a bigger pool so as to make the investing more efficient, both cost-wise and hopefully also performance-wise. Because in theory you basically don't you can minimize the per invested dollar costs of transactions, plus you can afford to hire somebody who's either more or less active with that money, but somebody who then looks after those resources, that they are invested according to what's agreed at all times, and maybe even succeeds in achieving something better than that's set as the target. That principle is very plain and simple. The way it works, I think in the older or some time ago, in a more traditional way, you would have the superstar manager who is then trying to roll the portfolio around many times and achieve a substantially better result than some stated benchmark. And as a contrast to that, it's maybe nothing totally new, but that's something 20 years old product, but we have the exchange traded funds that say totally the opposite, that you don't need the superstar trying to do anything better than the index, because you simply cannot beat the index. And the only thing you should care about is minimize the cost. So we have a bit of theories evolving around this efficiency, but the reality, I think, is that if you don't have those active guys trying to figure out where those mispricings happen, the passive vehicles will be bound to underperform. So in reality, it's one cannot live without the other.
So there's a range of risks according to whether you go for the high risk superstar or the more conservative kind of long-term approach. But you as a fund manager, how would you spend your day? I mean, is it scanning sheets of prices to spot value? Is it going out and meeting businesses and thinking, well, in 6 months' time this is going to be worth looking at? I mean, what's the range of activities you're doing?
It's actually what you say, that the superstar is the risky type, and then the passive approach is long term. I wouldn't quite agree. I think it's a bit of a choice in what you think is appropriate in each specific market segment.
Right.
And what we in our firm generally believe is that you should do investment decisions on common sense. I think that is kind of a very vague term, but kind of the uniting motto, and which then leads us to situations where those approaches, where we are kind of going maybe with the more passive vehicles, and where we are really trying to find the superstar or try to be the superstars ourselves. It really depends on the market segment, and we invest a whole range of different monies. We invest money for the pension plans, we invest money for some specialized investment funds, and some for private individuals. That means we cover actually a pretty good range of markets where we invest, starting from, well, the typical US equity, where we literally don't think we have the best odds of outperforming, so we don't really pay a lot of kind of classical effort to pick the winners out of the kind of the really just out of reading their financial statements or anything. But then again, they're really knowledge-based quantitative methods that we can still apply in the market and try to achieve a better result than let's say the general market. But again, we just don't do math for math's sake, but we apply common sense on those models as well, and that they are intuitively making sense. That generally, a well-managed company is likely to perform better than a less better managed.
So this, I guess, takes us back to the point you made earlier about it being multidisciplinary and the word you used, interconnected. If yes, you have the numbers which you can crunch and which anyone can crunch, but then the things like psychology, ethics, the philosophy of a company, or your insight into an individual who has the power to make decisions. This, I guess, then constitutes what might be misconstrued as, you know, the intuitive side of investing, because there is this sort of popular notion that, you know, it's just the guy who takes the bet and he gets it right and he's got the right DNA or something. But it sounds really that what that so-called intuition are these sort of extracurricular insights. Is that what you bring to a fund? Is this sort of extra wealth of knowledge, which is not strictly speaking financial markets knowledge?
I think one example that gives a good illustration of what you're mentioning is that among those various markets where we invested, there's also one particular strategy where we actually go all the way down, that we select individual securities really on a kind of the old-fashioned way that we understand the companies, analyze their financials, and so on and so on. That's Eastern European markets, where, and especially the bond markets there, that's that the things you mentioned there are all on the list. You need to understand the pretty complex politics of the region. We do meet either when it was still possible in person, but now it's increasingly online. So this year has been fully online, but we do meet company representatives of various sorts. We do try and sort of understand their business models to an extent so that we can form an opinion of whether their creditworthiness is rightly valued. And in that is one example of how those that interconnection of things happen. I mean, you need to understand the history and all those subjects to I think make a really quality opinion on those things, and that's something that we obviously have done pretty well, where my experience has been helpful. From my CEU times, I have a lot of acquaintances across the Eastern European region, so that helps to give like also this personal touch and personal flavor or personal perspective, validation of things, just with the locals in a way. So that's really, I think, is an example of that interdisciplinarity of things in this very, at the first glance, seemingly very finance dictated topic, which of course it predominantly is about economics and money, but I think the full color of it is actually much wider. But on the other hand, that is my experience. My experience has been with asset management. But then again, I think there's probably a chain of industries that appear like relatively understandable and pretty clear from mechanics point of view when you first look at them. But then when you get deeper and more involved, there's probably much more color appearing and it's all more diverse than it might initially seem.
I guess when you're talking about having, billions of euros, dollars, whatever under management, you're playing, whether you want to or not, an active role in national economies, in international economies. I mean, that must be quite an unusual feeling. I mean, do you feel that the assets you have under management, you have a responsibility not just to the investors who've stumped up to make this pool of cash available, but actually the knock-on effects that it's going to have in the economy? I mean, it might result in factories opening or closing or distribution of wealth from one region to another. It must be quite an unusual feeling for you to have sort of it slightly at one remove from it, but kind of responsible for it.
I think, yes, we manage something around 1 billion altogether in euros in money, and that's although it sounds like mind-blowing figure for an ordinary person, it's actually in the financial industry, global financial industry, we're really a tiny player.
Of course, yeah.
So we certainly are not people who are going to dictate where the Facebook stock is going to move these days. It's not our turf. But I think where you are right to say is that, one of the big chunks that we manage, of the money that we manage is the pension funds, and they are the largest accumulated capital in the Baltics. So to this date, and their investments in the local economy are, in fact, they play a significant role. We are constantly approached by various local entrepreneurs and also private equity managers. We don't do local private equity ourselves. We basically invest in the funds that are established for that purpose. And reality is that without the pension fund money, there's little chance actually of raising a Baltics focused private equity fund, which would then invest in companies, make them grow, or in startups to make things happen. So I think it's not that we feel like somehow empowered with a disproportionate role in the economic system that we have, but I think that has been a very good choice when those systems of funded pension systems that they were started and that they were made. I think the track record with all the popular debate, partly valid, but then again, I would say also a bit populistic. The fact that we have, at least in this, in Latvia alone, we have, what is the figure today? Something in excess of 4 billion accumulated capital that is invested, and it is totally unreliant on the state budget to support the pensions of future generations. That is a wonderful fact. And that is something that, and in contrast, the Estonians are currently basically dismantling partly that system. I'm not a politician and I'm not going to declare strong political opinions, but I think purely rationally that's not a good thing or wise thing to do long term, given the demographics where they stand. We cannot hope for pay-as-you-go systems that they will be able to create let's say, adequate pensions for the pensioners when they retire. But going back to the role in the Baltic economies, that role is certainly there via those alternative investment funds, the Baltic focused primarily. Yeah, I think that role would be even bigger if we had more or less shallow public equity markets. Those pension funds, they play a very significant role in government bond markets, of course, but also in corporate. Basically, the Baltics issued corporate paper will also be largely bought up by the local pension funds. So companies can borrow on the public markets from the pension funds because they exist. If we had not started to save up, we would not have that capital base that can support those needs. That opens up another debate of why the public markets are maybe not that developed, etc. But let's not.
I think maybe we need to get you back for another one for that.
Yes, there are maybe other people who can.
But there are a couple more questions I just wanted to run by you. One is it's a rather obvious one, but I think is worth asking as well. I mean, where do you draw the line in terms of ethics involving in investing in certain sectors or areas? Because I imagine it's unlikely that your own personal ethics tie absolutely and perfectly with the company ethics that the company you happen to be working for at any one point in time. Although being a member of the board, I imagine you also have greater sway in saying what's an acceptable investment and what's not. You have investments across various parts of Eastern Europe. Maybe some of them regimes might not be the most democratic. In other cases, it might be environmental issues. So how do you sort of square it on a personal level as well as a corporate level? In this I'm happy to invest in, this with certain conditions, this no way.
That's a very, very good and very broad question. Of course, maybe I think that's a bit of overstatement that, luckily, I think that is a bit of an overstatement that you have to make those ethical choices like daily. It's not, I would say that today, something that is outrageously or clearly on the verge of being claimed as potentially unethical is simply non-existent on the market. It's simply not going to be able to attract the capital that will make that instrument available at all. So that's, I think, maybe the first part of the answer. But then I think that the next and the bigger part of the answer is that the rise of responsible investing across the globe is maybe it seemed a bit of a fad 5 years ago, but today it's simply a norm.
So this would be like environmental funds or maybe religious funds or whatever.
Yes, there are, I think, hundreds of
different criteria.
of different forms of how that plays out. But the starting point is that investing responsibly is really becoming a norm, or rather the modus operandi, both on the issuer side and on the kind of the fund side. So the companies are increasingly reporting their activities in all the ES and G, like environment, social, and governance factors. So as those potential buyers, who are such as myself, the fund managers, have easier time figuring out what is actually their stance in those broad terms. So,
because from the outside, it can sometimes seem like I don't know, with corporate social responsibility or things like this, a window dressing. But you're saying no, they really do it really does make a difference in.
It is the term used on this is greenwashing, and that's a big debate on how do you in the large number of issuers and the large number of companies you have around and the large number other managers you have around? How do you actually separate out of those who are just kind of using the right terms and who are in fact actually serious about those affairs? It's a very complicated matter. I think we of course try and do that to sort those things out, but it's not easy, and I think there's no right recipe yet on how do you do that. But basically, what we've done, we have worked on integrating these factors already for some time. But last year we all went out and also signed formally those UN principles of responsible investing. They are by and large becoming a norm, and as a fund manager you're starting to look odd if you have not subscribed to them. And that in itself will then give you an obligation to integrate those sustainability factors in your investment processes. And then there's another debate, let's say, what is then the right philosophical choice, whether you should only invest in, typically people use the word green. That's kind of the first thing that comes to mind, because whether that's good for environment, but the green might also mean whether that's good for your community, etc. But the question is whether you should only invest in something that's green today, or you should rather aim for something that's maybe not as green today, but it's actually making an effort to turn from brown and to slowly turn into green. And very philosophically speaking, our thinking is that the latter approach is actually it has more impact. So what that means at the end of the day is paradoxically that you don't create a blacklist of things. You don't say that you will never ever invest in oil or coal or something. Well, it will be hard time for you to do that, because it's going to be basically downgrading your or rather increasing the required return if you are to do that. But basically, the construct that we're trying to build is that we want to favor the companies which are making progress in whichever way you measure the ESG, and punish those that are not making that progress. Globally speaking, that is how I think the big transformation of the capital markets is undergoing. That's started out, I think, as really trying to respond to all the climate changes that we have, but I think it has grown into a much wider change, and I don't know yet how it will shape up in 5 years or 10 years from now, but certainly that is becoming a norm, and there's no way around it. That is going to be a bit fairer capitalism that we will hopefully achieve.
But I think that takes us nicely back to the idea of being interconnected as well, in that if you can't immediately leap to green paradise, then actually being aware of the processes and the incremental improvements that might get you there, even via coal or via let's say polluting or carbon fuel sources, I guess is the way to go, and that being interconnected will allow you to incrementally get there, rather than just leap into a ethically pure heaven, which might not actually arrive otherwise. But anyway, I'm afraid we're out of time. It would be great to have you back to talk a little bit more, because we've only just scratched the surface, I think, here. So thank you very much for joining me today.
I've enjoyed this. Thank you.
And after the podcast is off, I'll be trying to get a few investment tips from you, but not online. Okay. Thank you very much.
Thank you. Thank you.
Thank you for listening. This podcast was produced by SSC Riga. If you'd like to learn more about the topic, visit the open course schedule at SSC Riga Executive Education. For more podcasts, find us on Spotify, iTunes, or the platform of your choice. Remember, share this episode with your friends and colleagues.